Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about ORKT, Orange Cloud Technology Inc., ticker ORKT. Presents one of the most compelling and frankly concerning cases of microcap distress we have seen this year. This is a Singapore-based enterprise software provider, and they specialize in the low-code, no-code market, or LCNC. Right now, as of December 8th, 2025, the stock is trading near $1.04. It's a jaw-dropping collapse. We're talking down over 90% from its 52-week high of $17.84. And now the company it's fighting desperately just to remain listed on the NASDAQ, hovering perilously close to that $1 minimum bid price. They even tried a survival maneuver, a 1-for-4 reverse stock split back in September. And that scale of volatility is exactly what demands our attention. I mean, a beta of 4.61, that means its movements are more than 4 times as violent as the broader market. So the central disagreement we really need to explore here is whether this near-catastrophic price action is driven fundamentally by the severe deterioration of the company's internal financials, or if external factors are the real culprit. Things like adverse market microstructure and the kind of toxic financing mechanisms that are so common in this small-cap world.
I hold that the price reflects a fundamental crisis. The managerial decisions, they've led to such profound financial damage that a $1 valuation is sadly largely justified. This stock isn't just suffering from market skepticism. It's a textbook example of a management team just destroying shareholder value through horrible fiscal discipline and a total failure to execute. And I come at it from a different way. While the financial distress is obviously severe, nobody's denying that. I believe that the structure of the market and some very specific governance choices are the accelerants. They're amplifying the distress to an extreme degree. It feels like external forces are trapping the security in a relentless downward cycle, regardless of whether the company's operational losses were, say, 5 million Singapore dollars or 10 million. If the financials were just weak, the price action wouldn't show this kind of structured, aggressive suppression.
To really understand the extent of this internal failure, we have to look at the financials. And we should use the figures they reported in Singapore dollars, SGD. The trajectory it's damning. From fiscal year 2023 to 2024, revenue contracted by over 33%. It fell from SGD 6.09 million down to 4.04 million. This is a shrinking company. And yet the costs weren't controlled. In fact, administrative overhead, the G&A expenses, they didn't just rise, they exploded by a staggering 219%, reaching SGD 9.43 million. I see why you think that market forces are the decisive factor, but let me give you a different perspective on this. The capital they raised in the IPO was almost entirely consumed by overhead, not by productive assets. And more crucially, and this is for a software company whose entire business model relies on its LCNC platform, research and development spending was slashed by nearly 95%. It's down to a negligible SGD $30.62 thousand. This signals a complete stop to innovation. This isn't a market-suppressing value. This is management opting out of the competition.
Okay, and I absolutely acknowledge the severity of that R&D cut. And the fiscal mismanagement in that G&A explosion it's undeniable. But I challenge the premise that these internal failures alone can account for the share velocity and the specificity of this stock's decline. We are looking at a market microstructure that feels almost actively designed to amplify distress in these low-float, high-volatility names. I mean, look at the data on off-exchange trading. On November 28th, 2025, an extraordinary 69% of all trading volume was short volume executed off-exchange, most likely through dark pools. This indicates very aggressive institutional positioning, specifically arbitrage and short selling. That's all happening away from the lit NASDAQ exchange where the average investor sees the price. This high level of dark liquidity ensures that any emerging demand is instantly met with supply off exchange. It just systematically disconnects the price from true public supply and demand. This mechanism is what sustains the retail trap narrative, and it actively suppresses the valuation independent of whether the company lost 5 million or 15 million SGD last quarter.
That structural critique about dark pools is important. I'll grant you that. But we can't forget what created the vulnerability in the first place: the operational collapse. The net loss accelerated unchecked to SGD 8.65 million. At 219% surge in G&A expense right next to a shrinking revenue base. That is not an external headwind. That is poor fiscal discipline and a profound managerial incentive misalignment. The company burned through its capital. This is the definition of internally generated value destruction. How can any market mechanism create a 33% revenue contraction? It can't.
That's a compelling argument, but have you considered the structural elements that compound and accelerate this fiscal damage? The mismanagement is undeniable, sure, but the market applies a severe governance discount here. ORKT is incorporated in the Cayman Islands, and critically, it employs a dual-class share structure. The insiders hold 7.48 million Class B supervoting shares. Now, this structure means public shareholders are, well, they're virtually powerless. They can't vote down that egregious G&A explosion, nor can they hold management accountable, even when the losses are accelerating catastrophically. So the market isn't just pricing in the operational losses, it is pricing in the inability of public investors to affect any kind of governance change. This opacity makes sophisticated institutional investors extremely wary, and that limits the natural buying capital that might otherwise stabilize the security.
The structure essentially tells the market high costs are going to continue indefinitely because the people setting those costs are immune to shareholder pressure.
And that inability to control costs due to the governance structure leads directly to the next point of failure, the reverse split. The 1-for-4 consolidation they did in September was not a sign of confidence. It was a desperate regulatory compliance move. And the market sees this, correctly I think, not as a solution but as a necessary precursor to dilution risk, the classic death spiral scenario. The split artificially raised the price above the $1 compliance threshold, sure, but the subsequent fade right back down to 104 confirms the market's expectation. It knows the company will inevitably need to tap the capital markets, probably through an at-the-market offering, an ATM, just to fund those accelerating, uncontrolled losses. The split provided a runway, but not for the business. It provided a runway for more equity supply, which is the most aggressive form of value destruction for the current shareholders.
I agree that the reverse split signals desperation and prepares the ground for dilution, but the resulting price action after the split confirms a very distinct short attack dynamic that is enabled by this toxic market structure. Following the split, the stock did briefly trade up to $2.08 in mid-October. That bounce was swiftly, almost surgically, just overwhelmed. Sophisticated traders see a reverse split as an invitation. It clears the board and offers a renewed runway to short the stock down all over again after the compliance requirement is met. The volume profiles, coupled with that sustained high dark pool short ratio, demonstrate that market makers and institutional shorts are actively and efficiently absorbing any buy-side demand off exchange. They use this engineered volatility highlighted by that 4.61 beta to push the price precisely back toward that regulatory tripwire of $1.
The reverse split didn't solve the problem. It just provided a temporary technical window for market participants to accelerate the stock's structural distress.
You talk about acceleration, but what accelerates faster than the death of the core product? We can't let a fascination with market mechanics obscure the existential risk posed by that R&D decision. The 95% cut in R&D, that leaves the EMO-BQ platform with negligible funding. It turns it into zombieware. In the LCNC space, the competition is defined by giants like Microsoft Power Apps and ServiceNow. These companies innovate relentlessly. An LCNC provider that stops innovating forfeits its competitive edge immediately. It guarantees they will miss critical security updates, feature parity, cloud architecture upgrades, everything necessary for enterprise sales. This is a management decision to manage purely for administrative survival and cash conservation, not for growth. And that is the fundamental reason institutional money avoids it. The structural pressures you're citing, they're just capitalizing on a product that is already guaranteed to fail.
I would argue that in a liquidity crisis fueled by governance failure, the R&D cut, while catastrophic long-term, is an inevitable symptom of short-term survival. Management, however misguided, is cutting discretionary spending to preserve cash because the dual-class share structure allows them to ignore public shareholders while they navigate this financial hole. The R&D cut is a consequence of the mess. The auditor change, however, that's a deeper governance malignancy.
I'm not convinced by that line of reasoning because there is another governance issue that carries an arguably larger discount factor for sophisticated money: the auditor switch. In November 2024, the company dismissed Simon & Edward LLP, the reputable firm that handled its IPO, and engaged Enron LLP.
Now, Enchroma is a smaller, regional firm whose client list, when you look at it, concentrates heavily on high-volatility microcap issuers, many of which share that same Cayman Islands domicile and high-risk profile. This move is textbook auditor shopping. This downgrade in governance oversight adds a critical layer of opacity and risk about the quality of internal controls and the enforceability of disclosures in a jurisdiction that's already viewed with skepticism. Institutional investors, who ultimately influence the market microstructure by either buying or staying away, they will discount this governance issue severely. They are effectively saying, we don't trust the numbers, regardless of how low the R&D is. And that is a distinct, non-fundamental source of valuation compression.
That audit change is certainly a massive governance red flag, I agree. But even if the numbers were perfectly audited by the best firm in the world, they would still show a company operating at a catastrophic loss with absolutely no future product viability. If the auditors confirm that the company loses 8.65 million SGD a year while starving its core product, what value is even left to suppress? The structure simply makes the consequences of the fundamental failure inescapable. My position remains rooted in the reality that the core business model is fundamentally broken. We have shrinking revenue, spiraling administrative costs, and the absolute stagnation of the technology. The $1.04 price isn't some mysterious market failure. It simply reflects the massive destruction of shareholder value, all the way down from the $4.75 IPO price caused by internal, managerial failures and severe incentive misalignment.
And I'll just reiterate that while the fundamentals are poor, the combination of specific market structure and governance choices acts as a powerful accelerant and a trap. The extreme beta of 4.61 and the specific, persistent, and extraordinarily high dark pool shorting activity, they all confirm that this stock is trapped in a structural downward drift cycle fueled by external pressures. The governance structure, defined by the dual-class shares and that opaque auditor switch, limits investor recourse and ensures that external market forces will succeed in pushing the price down to the NASDAQ compliance brink again and again.
Orange Cloud technology is undoubtedly a security facing high speculative risk, driven by the complete collapse of its internal fiscal controls.
And its trading environment illuminates the dangers inherent in these low-float IPOs when they're combined with severe corporate distress and a total lack of public shareholder rights.
Listeners really must weigh whether the predictive power for ORKT's future price action lies more heavily with the fundamental health of the business, which is, at the moment, non-existent, or with the powerful structural forces that control the microcap trading environment. Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.